Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
Hello everyone and welcome to my channel. As promised in a previous video, today we will discuss diversification when it comes to investing. As an added bonus, if you stick with me until the end, we will tackle another concept that is easily thrown around as a counter-argument to investing in high-growth stocks, and that is the university thought variation of the idea of value investing. Both of these concepts have strong fundamentals behind them and a great track record to solidify their stance. But like everything else in life, things evolve. And in this day and age, technology is the main driver for that evolution. So if everything evolves, so should us as investors, and so should our financial education. But first, I want to preface the following with two things. Number one, this is not financial advice. This is just my opinion, and this is for education purposes only. Number two, this video is for people that want to maximize their profits and want to invest time and energy into this activity. If you want to have average returns, or you don't have the time, or you just want to preserve your wealth, then this video is not for you. You are better off investing in an ETF that tracks the S&P and call it a day. Before we go further into the concept, let's define the term diversification with a quote from Investopedia. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. Studies and mathematical models have shown that maintaining a well-diversified portfolio of 25 to 30 stocks yields the most cost-effective level of risk reduction. The investing in more securities generates further diversification benefits, albeit at a drastically smaller rate. Now that we are perfectly aligned on the meaning of the term, let's get into it. Honestly, I wrote a whole script about these topics that was centered on my opinion and my thoughts, but in the end I decided to scrap that and let two people that need no introduction, whose views are aligned with mine down to a T. And I know they will explain it better than I would ever can. We will follow together what they have to say, and I will give you my 2 cents when I feel that I have something of value to add. With that being said, let's watch and learn from two living legends when it comes to investing, Warren Buffett and Charlie Munger.
We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah.
I know this is a lot to unpack, and it might be unpleasant for some of you guys, but from my experience, I find this to be 100% true. Also from experience, I learned that it is really important to learn from the best, but it is equally important to take that information, internalize it, and then think for yourself. Create a model in your mind, then put it on a piece of paper and see what applies and what doesn't. As an example for that, I don't always agree with the decision taken by Berkshire Hathaway, but on this topic we are fully aligned. And the reasons in this video are extra reasons besides those that you will find in my playlist why I think Tesla is the stock to go all in. If you are a decent investor, you already know what I've been trying to preach in most of my videos. The first rule in investing is never invest in a company that you don't understand. So therefore you have to learn everything you can about a company, Do deep dives, and when you're done, learn some more. And after you did that and you invested your money into a company, the second rule is always be up to date with what that company does. Follow the company politics, their managers, and always verify that the fundamentals haven't changed, and always reevaluate your decisions. In my playlist on how to evaluate a company, there are a lot of checks that I present. But even if you apply only these two rules and you are not some kind of a genius, it will be immensely hard to keep track of 3, 4 companies, not to mention 10, 20, 50. To create wealth, it is enough to find one good company. If you manage to find 3 in the span of your lifetime, you will be set. To sum it up, when it comes to diversification, my opinion is simple. It is not for me. My goal when it comes to investing is to find a few great companies that I will hold long term and I will reap the benefits in a decade time. And at this point, from my research, the best company that I found is Tesla. There are 2 more that I would like to invest if I would have an infinite amount of money, but I don't, so then I draw the line at the current company that I just told you about. I hope the previous section answered all your questions when it comes to my opinion about diversification. Now, as promised, we will tackle the second term that is thrown around when it comes to buying great growth stocks, and that is value investing. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Value investors actively ferret out stocks they think the stock market is underestimating. They believe the market overreacts to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. The overreaction offers an opportunity to profit by buying stocks at discounted prices, aka on sale. If you abide by this definition, then everything is more than perfect. And I think this is the best strategy to apply, and it will bring you millions. But from my point of view, in the last decade or so, universities and financial education materials have eroded at this definition and have warped it into something that has turned into a dogma. That dogma is based only on numbers and has little to none margin of variance. And that is wrong in my opinion. I don't believe anything is absolute in this world. As said earlier, you have to evolve and adapt and find value where value is. When it comes to this approach, this way of investing, Warren Buffett is probably the best known investor in the world that fits this bill. Second to him is his partner, and I've chosen this video of Charlie Munger because of his reputation and his usual stance when it comes to this subject.
In other words, does it change the investing philosophy of Berkshire? So if Berkshire and Warren and you were known as value investors, is that not the core discipline of Berkshire Hathaway anymore, or does that not even matter?
Well, you got to remember that in our way of thinking, all intelligent investment is value investment. Because why would you want to buy something which wasn't worth as much as you were paying for it? And who wouldn't like buying something for less than it's worth? So the only difference when people talk about value investor, you're always a value investor. Now there are various ways to look for value investments, just as there are various places to fish. And if the first rule of fishing is to fish where the fish are, the first rule of value investing is to find some place to fish for value investments where there are a lot of them. And of course it's gotten hard in the United States to find easy value investments because the world is so competitive. And that accounts for a lot of what you see in Berkshire, where we buy securities like Apple that we wouldn't have bought in the old days when we had more mundane things that were serving us very well. So we're just looking in different places, but we're value investors.
And so
some people, when they say value investor, they mean somebody that emphasizes working capital or something, meaning you should fish in that particular place. But I think that's all. I think it's a bad use of the language to think there's a difference between value investing and other good investing. All good investing is value investing by definition.
Okay.
They're just various places to fish for value investments. And of course, as the world gets tougher, you have to fish in places you didn't fish before.
The idea with Apple then is that there's value there that's unrecognized by the market.
Different kind of value investing, and one with which we're less familiar. But we wouldn't have bought it if we didn't think it was a good investment.
So there you have it, boys and girls. My opinion and my view when it comes to value investing, told by the man, the myth, the legend. There are many things that can be said, but one thing is for sure. They are two of the best investors of their time, and they have made billions for themselves and their clients. As previously stated, I want to hammer down the idea that I'm not just echoing what other people are saying. I've learned from them, then did the opposite, and with time reached the same conclusion, while losing time and money in the process. For the reasons stated in today's video, and many more that you can find by clicking the card in the corner, at this point in time I own only one stock, Tesla stock. That being said, I want to be fully transparent. I don't own only stocks. I do have money in real estate and hold around 1% of my net worth in cryptocurrency. Some of the information in this video comes directly from Investopedia. Therefore, you can find links in the description with more reading material if you want to go down the rabbit hole, and I encourage you to do it. Knowledge is power, and power means money. I hope you enjoyed this video. Please hit the like button if you did, and don't forget to subscribe if you don't want to miss out on more videos like this. I will be continuing my All-In on Tesla series that will show you how to evaluate a company and add further tools in your toolbox. Kind regards, and see you in the next one.